Assalamu alaikum. This is the third video on translation of foreign affiliate financial statements. In this video, we will continue explaining forward contract as a hedging instrument. We will talk about the fair value hedge, hedging an unrecognized foreign currency commitment. We will look at fair value hedge, which is hedging an unrecognized foreign currency commitment, and then we will solve an illustration and a problem. But in the beginning of this session, I would like to thank my son, Muhammad Abdullah Khan, who gifted me an iPad along with all the necessary accessories without which making these videos would not have been possible. I would like to thank Nabia Khan for helping me out in preparing these awesome slides. I would like to thank my wife Samina for her care, encouragement, and constant support, who allowed me to use time for her in making this video. In the previous video, we talked about the kinds of forward contract. We also solved an illustration and a problem on foreign currency transaction. In this video, we will look at fair value hedge, which is hedging an unrecognized foreign currency commitment. We will start with explaining how to use a forward contract as a hedge that is considered a fair value hedge. A Saudi firm at a date earlier than the transaction date, the date the company do the exchange, make a commitment before the transaction takes place to a foreign company to buy or sell goods or services at a price established in foreign currency. For example, today the firm make a commitment to buy goods and services, and it makes a commitment to buy goods and services 14 months later, and this transaction will be denominated in foreign currency. So the commitment is made today, and this is a firm commitment. That means the company cannot change it. Such transaction is called unrecognized foreign currency commitment. So transaction has not taken place, but there is a commitment, and this commitment is firm. The company cannot change it. Changes in the exchange rate between the commitment date and the transaction date will be reflected in the cost or the sale price of the asset. So between the commitment date and the transaction date, any changes will need to be recorded. The Saudi firm may enter into a forward contract to hedge its commitment to protect from the unfavorable fluctuations in the exchange rate. All the adjustments are recorded in the income statement. A fair value hedge is considered effective. That means overall there will be no gain or a loss. Please note that if a hedge is effective, it means the changes in terms of gains or losses are eliminated. Let us see how this works in an illustration. Consider the following information. On March 1, 2010, a US firm contracts to sell equipment to a foreign customer located in Argentina for 200,000 pesos. The equipment is expected to cost 60,000 to manufacture and is to be delivered, and the account is to be settled 1 year later on March 1, 2011. Thus the transaction date and the settlement date are both March 1, 2011. So the commitment is done on March 1, 2010. Transaction will take place on 1st March 2011. This is a hedging for an unrecognized foreign currency commitment, and the firm will hedge against it. On March 1, 2010, the US firm enters into a forward contract to sell 200,000 pesos in 12 months at the forward rate of 0.39. So the US company wants to avoid unfavorable exchange rate risk on 1st March 2010. Therefore, they want to find someone who agree to buy 200,000 pesos at the rate of 0.39. So the US firm will receive 200,000 times 0.39, that is 78,000. The spot rate and the forward rate for pesos on selected dates are given over here. On 31st December, the spot rate is 0.387, and this has no relevance in a fair value hedge, as the spot rate has nothing to do with the transaction, as the transaction doesn't take place until 1st of March 2011. So first, the US company will record the forward contract to sell 200,000 pesos. So dollars receivable from exchange dealer is debit and foreign currency payable to exchange dealer is credit by the same amount. This will be posted in the T account over here, and please note that the receivable is the fixed amount in this example, as the company entered into the forward contract to sell pesos. The payable is the forward contract, and we will look into the changes in this account. 9 months later, on the balance sheet date, the foreign currency payable needs to be adjusted to fair value using the change in the forward rates. You can see that the forward rate has decreased, so this is a gain in our case, and this is, you see, since we entered into a forward contract, so our receivables are at the rate of 0.39. Had we waited for 31st December, we would be receiving our receivables at the rate of 0.382. So there will be a decrease in our payables and forward, so our liability is going to be decreased by the difference, and the difference is of 0.008. So that's how we record the gain on fluctuation in the forward exchange rate. But note that the fair value hedge is an effective hedge, so the gain must be offset with a loss. This loss is a firm commitment, and since commitment is not recorded yet in the books, so a liability is created, what we call as firm commitment. So exchange loss is debit and firm commitment is credit, and that's how we record this in our T account. On the income statement, the exchange gain of 1600 is reported, as well as the exchange loss of 1600 is reported. And on March 1, the transaction date and the settlement dates are same, and let us see how we record it. Now again, if you can see on the settlement date, the spot rate will be our forward rate as well, and again the forward rate has decreased. So when it is decreasing, it means again this is a gain for us, because our payable is going to decrease by this amount. So foreign currency payable to exchange dealer is debit and exchange gain is credit. And again, since this is an effective hedge, so gain must be offset by recording the losses, and that's how we record the losses over here. Now, because of the forward contract, the amount of sales is going to be recorded now, because the transaction date and the settlement date is March 1, 2011, and the sales is at the rate of 0.39, so it is 78,000. And since we are recording the activity to be hedged, so now we are going to eliminate the firm commitment. We have a credit balance of 16 and 40 and 400, so the firm commitment is going to be settled now by writing it off, and that's how, so firm commitment is debit by 2000, and that's how we close it. Now, remember I told you that this account is going to be fixed, and now we receive this amount in the form of cash. We will receive cash, so cash is debit by 78,000, and dollars receivable from exchange dealer is credit by 78,000, and that's how we close this account. Now looking at the forward currency payable, we had initially the balance was 78, and then there was debit of 16 and 40 and 400. So the payable on March 1 is 76,000, and this 76,000 is going to be settled now by transferring it into an investment. So the investment was 76. Now we receive this money and we settle the investment account as well. So investment is debit by 76, and that's how this account is recorded, and then we settle this account as well, and this journal entry is also complete. Finally, we are going to record the cost of goods sold, that was 60,000. So cost of goods sold is debit and inventory is credit. Now the effect of these transactions on the firm's profitability is, you see the sales is for 78,000, and the cost of goods sold is 60, so the gross profit is 18,000. So the forward contract permitted the US firm to lock its expected profit of 18,000 on the sales contract. If the forward contract has not been obtained, the profit earned on the contract would be depending upon the exchange rate in effect when payment was received from the Argentinian customer, and that may be at the rate of 0.38. Without the hedge, the amount of sales recorded would be 76,000, and the gross profit then will be 76 minus 60, that is 16,000. And if the exchange rate has dropped below 0.38, the amount of sales recorded would have been even lower. Finally, let us solve an exercise on fair value hedge and consider the following information. On December 1, 2008, a US firm contracts to sell equipment with an asking price of 10,000 pesos in Mexico. The firm will take delivery and will pay for the equipment on March 1, 2009. So the commitment is on 1st of December 2008. The transaction takes place on 1st March 2009. And this is the hedging for an unrecognized foreign currency commitment, and the firm will hedge against it. On December 1, 2008, the company enters into a forward contract to sell 10,000 pesos for 9.48 on March 1, 2009. So the US company wants to avoid unfavorable exchange rate risk on 1st of March 2009. Therefore, they want to find someone who agree to buy 10,000 pesos at the rate of 9.48. So the US company will receive 94,800 for this contract. The spot rate and the forward rate for March 1, 2009, the settlement were as follows, and they are given in this table over here. On 31st December, the spot rate is 9.49, and this has no relevance in a fair value hedge, as the spot rate has nothing to do with the transaction, as the transaction doesn't take place until 1st of March 2009. On March 1, the equipment was sold for 10,000 pesos, and the cost of the equipment was 40,000. So first, again, the US company will record a forward contract to sell 10,000 pesos, and we debit the dollars receivable from exchange dealer and we credit foreign currency payable to exchange dealer. Please note again that receivable is the fixed amount in this example, as the company entered into a forward contract to sell the pesos. The payable is the forward contract, and we will look into the changes in this account. On 1st of December, there is only one transaction to be recorded, that is the hedging contract. Since this is a fair value hedge, so there is no item being hedged on this date. Now, on 31st December, the US firm will look into the fluctuations in the forward rate only, and the forward rate decreased from 9.48 on 1st of December to 9.44 on 31st December. So this is a gain for the US firm of 0.04 US dollar per pesos, as they have the receivable. Had they waited for 31st December, they would have received 94,400 in place of 94,800. So the payable is to be reduced by 400 and a foreign gain to be recorded by crediting it. Also note that a fair value hedge is an effective hedge. So when the hedge goes up, the item being hedged goes down, or when the hedge goes down, the item being hedged goes up. So they work in opposite directions. So the gain here is to be offset with a loss, and this loss is the firm commitment. Now, since the commitment is to be recorded yet on the books, so a liability is created called firm commitment. Foreign exchange loss is debited and firm commitment is credited, and that's how we show it in the T account. Next, let us see what happens on 1st of March. On 1st of March, the transaction will be settled and two things will be recorded. First, adjust the hedge, foreign currency payable from exchange dealer. Since the forward rate and the spot rate are the same on the settlement date, the hedge position worked against the US firm between 31st December and 1st of March, and company suffered a loss. You see 0.944 and now it is 9.47, so there is a loss of 0.03, and the US firm has a loss of say 300 now, and the journal entry will be debit foreign exchange loss and foreign currency payable from exchange dealer will be credited. Also, since this is a fair value hedge, so it is an effective hedge, and there is a loss on the item being hedged which is not recorded yet on the books. So firm commitment, a liability will be recorded. Before by reducing it by 300, and foreign exchange gain will be credited by an equal amount. Now let us look at the balances in the T account. First of all, the payables, and if you look into the payable, 94 and this will be 95, so we will be having a balance of 94,700. So on 1st of March, the US firm is also going to make the sales. They will be delivering the goods, and the sales will be for 94,800. Now we have remember that we have this receivable as well, and this receivable is fixed and we receive cash for that, 94,800. So dollars receivable from exchange dealer is credit and cash is credit by 94,800. Then there is a payable of 94,700. So this will be recorded as an investment as well. So investment is debit over here by 94,700, and you can see we have investment here for 94,700 on 1st of March, and at the same time it is going to be credited as well for the equal amount. So foreign currency payable is debited over here by 94,700 and investment is credited by 94,700, and that's how we have settled these transactions. Finally, we are going to record the cost of goods sold. The cost of goods sold was 40,000. So cost of goods sold is 40,000 and inventory is credited by 40,000. So this is a fair example of fair value hedge. What is interesting about the fair value hedge is that there is a firm commitment. That means it's an effective hedge. Effective means gains and losses goes to the income statement and they will cancel each other. If there is a gain on the hedge, there will be a loss on the item being hedged. If you have a loss on the hedge, there will be a gain on the item being hedged. Since there was no item to be hedged on 1st of December in this transaction, in this exercise, um, so an account by the name firm commitment is created to keep a track of it. So this completes the third part of our explanation on foreign currency transaction. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question regarding this session, then please don't hesitate to ask in the comment box or by email, and inshallah I will reply you back. Happy learning.